As a retirement advisor for over 20 years, my job is primarily to share my advice with my clients. And in today's video, I'm going to share with you the 8 most impactful and important pieces of advice that I share with my clients. So let's jump in. The first piece of advice is I really encourage you as you get close to retirement, but before you actually tell your boss, your company that you're going to retire, I encourage you to test drive out your retirement budget. Oftentimes people will say, oh, we can live on 60% of what we were spending before, 70%, 80%, whatever the number is. And it's one thing to do that from in an Excel spreadsheet and in your budget. It's another thing to actually live that budget. So I really encourage you to, as best you can, live that budget for at least 3 months and preferably 12 months. It's not unusual for people to say, you know what, that's a little tighter than what I want to live on. And so when you come to a financial advisor, when you think through how much money you're going to need in retirement, the number one factor that says how much money you need to have saved before you can retire is how much you want to spend in retirement. So have a really good feel for that. The difference between spending $5,000 a month and $6,000 a month has a material impact on a well-thought-out retirement plan. It really can. So I think it's really important that you live your retirement budget first. Okay, so how do you know how much you're likely going to live on? There was a study that was done by Dimensional Funds in 2013 by 2 PhDs, Massey DeSantis and Marlena Lee from Dimensional Funds. And they did a really nice study. And, the general rule of thumb is people spend 70 or 80% of their pre-retirement income. That's what they need to live on in retirement. But this is really important. Like I said, the difference between planning with $5,000 a month and $6,000 is significant. So I like this study because it broke it out in a logical way. It said how much money, let's categorize people based on how much money they were making before they retired. So in this case, it's an older study. The study's now, 13 years old. Because they broke it out by quartiles, people making the lowest quartile, the next quartile from an income standpoint, all the way up to the top quartile, the 25% of, in this case, Americans making the most money. So let's look at this. In the lower quartile, what they found, and it makes a lot of sense, is folks needed to have at least 82% of their pre-retirement income. And the reason it's not lower than that is in the lower quartile, there wasn't much to cut out. Everything was a necessity. So in this case, you can see Social Security is going to be 60% of that replacement income, and the other 23% has to come from their retirement savings. If we go to the next quartile up, so people from the lower quartile up to the median, those folks needed less because there were things in their budget that they could cut out. They needed 72% of their pre-retirement income. And you can see that split pretty evenly between Social Security and savings. 38% coming from Social Security and their savings providing the other 34%. Let's keep going. For the people that are between the median and the upper quartile, so the 50th to the 75th percentile, folks in that category needed 62% of their pre-retirement income. And it's split exactly half and half. Little over 30% comes from Social Security, and a little over 30% comes from their retirement savings. And finally, for people making the most money, folks in the upper quartile, you can see their replacement income was under 60%. It's 58%, with a little over 20% of that coming from Social Security, 21%. And the other almost 40%, 37%, coming from their retirement savings. So that's item number one from an advising standpoint, is live on your pre-retirement, live on what you think your retirement budget is going to be for at least 3 months, preferably 12 months, before you make the final decision to retire, just so you see what it's like. You might say, you know what, I'd rather work a couple more years and have a higher lifestyle. Okay, advice item number two is just reminding folks that taxes are going to be a major expense in retirement. Oftentimes people don't even budget taxes. If I send a family home and say, think about what retirement's going to cost and budget things out, so they'll have housing in there, they'll have car expenses, they'll have food expenses, vacations, etc. But you know what very, very seldom is in there? Taxes. And really, for the first time in many people's lives, they're going to be able to control how much they pay in taxes, particularly in those early years in retirement before they're forced to by the government through required minimum distributions to start taking money out of regular IRAs and regular 401ks. So in those first couple of years, if you wanted to, many people could pay $0 in taxes. Now, in general, you want to have a withdrawal strategy for how you're taking money out in retirement, because it literally, for sure, thousands of dollars, and for many viewers, tens of thousands of dollars, they can save in taxes if they do it strategically. In high level, none of this is financial advice, by the way. Deal with an accountant. And for something like this, it's really worth investing that money in an accountant, investing that money with a financial advisor that knows your situation, that can help you with it. But in general, you want to make sure that you're taking full advantage of the lower tax brackets in the United States. So in the U.S., the two lowest tax brackets are 10% and 12%, and then it jumps up by about 10 percentage points. So you want to take advantage of those low brackets rather than pay no taxes for the first couple years in retirement and then have some of that income be paid at the higher brackets. You want to take advantage of that. For most of us, paying a 10% federal rate, paying a 12% federal rate is a pretty attractive rate to pay taxes at. So you want to fill those up. And the concept is looking at the various buckets, if you will, of where your money are, where it's a regular IRA, a regular 401k, or it's a Roth IRA and a Roth 401k, or it's your regular bank account that you're paying tax as you go. So there's those three major types of accounts, and strategically thinking through how much money you're going to withdraw in each year from each of those buckets can really have a big impact. Another thing that can have a huge impact is the third piece of advice, which is your health is much more important than your wealth. So as a financial advisor, I spend a lot of time talking about people's wealth and their money. But it's equally important, in fact, I would say it's much more important, to continue to work to stay as healthy as you can. Go to the gym, try to eat right, exercise, take care of yourself, not just physically, but also mentally. If you're dealing with some stress in your life, maybe it makes sense to go see a therapist and invest in seeing a therapist. Or if you're not in the shape you want to be in, maybe it makes sense to hire a coach. You know, if you've been trying to do something for 10 years and you've been unsuccessful at it, you know, if you don't change anything in the next 12 months, guess what the likely outcome is. And in mea culpa, I've been trying to lose 10 pounds for several years. And in 2024, that was the year that I hired a trainer. So hopefully that works for me. Stay tuned. But our health is worth investing in. And here's a chart that's really a wake-up call for you. When you retire, most people retire about 65. You know, most of us have about 20 years of life expectancy. But the question isn't necessarily life expectancy. That's important. But you know what else is important is your healthy life expectancy. And the World Health Organization does a study, and the study is kind of complicated and difficult to bring the insights out. But I want to thank jeffknobs.com for putting together this chart. So the green lines are the top 10 countries that have the longest healthy lifespans. So the first one's Japan. They have 74.1 years until most Japanese are going to start to lose their health, which is really what this healthy life expectancy is. At what age does the average person in that country lose their health and start dealing with serious health issues? In Singapore, it's a little under 74 years, 73.6. Korea, 73.1 now. Hopefully we're going to come to the U.S. here pretty soon. Nope. The next country is Switzerland, then Cyprus and Israel, all at about 72. How about the next three countries? Is the U.S. in the next three countries? Unfortunately, no. It's Spain, France, and Iceland, right at 72. Well, hopefully this last green bar is the United States, but unfortunately it's not. It's Italy, and it's 71.9 years. Okay, so where's the U.S.? Hopefully it's 71.8. Take a look at that. It's shocking. It's 66.1. So when does the average American retire? This chart here shows when the average American retires. You can see in 2022, only a third of all Americans are retired between 60 and 64. Look at this, 40 to 44, only 1% of people 40 to 44 are retired. 45 to 49, 2%. 50 to 54, only 6%. And this is really the heart of my channel. As a financial advisor for over 20 years, I see people putting off retirement. The American tradition is we work until we're 65, and if you're healthy at 63, 64, 65, you think, okay, I'm fine. But then you find out, maybe you've got heart disease, or you have a stroke, or you get a cancer diagnosis. And so you worked all these years in order to enjoy your quote unquote golden years, and they get stolen from you because you lose your health, as we talked about earlier. So 55 to 59 is 11% of the U.S. population. I would love to see that be 40%. And I'm not saying that early retirement is right for everybody, that retiring 55 to 59 is right for everybody. But what I do think is right for everybody is to be thoughtful and deliberate about when you retire, particularly if you have enough money to retire now and you continue to work because you're telling yourself you love your job. And hopefully you do. But there's been multiple studies in the U.S. that have been done that show that only 20% of all U.S. workers truly love their job. If you look at an anonymous survey, sometimes you'll see results that say 80% of Americans love their job. But you have to look and see if people were able to report that anonymously or they had to put their name on it. Interestingly, the number is 80% when you have to put your name on this employment survey. But when you can do it anonymously, it's only 20%. So be careful. So we talked 55 to 59, it's 11% of people are retired. 60 to 64, it's 32%. And then 65 to 69, here it's 70% of folks are retired. And then 70 to 74, there's still almost 20% of people continue to work. Okay, let's keep going. So we talked about health span. Another important piece of advice that I share with my clients is their susceptibility to negative returns in the early years of your retirement. Now, there's nothing you can do to control the stock market. If you get unfortunate, like in 2007, 2008, when the market crashed, or if you retired in 98 or 99 and the dot-com bubble burst, or you retired just before COVID and the market fell, it was the quickest drop ever in the stock market history. We cannot control that, but I think it's important that you understand sequence of return risk, which is kind of the evil twin of dollar cost averaging. And the concept of dollar cost averaging is more intuitive, right? If you had $10,000 to invest, rather than put the money in all at once, which actually the studies show you're better 80% of the time, you're going to do better doing that. But if you did dollar cost averaging, let's say you put $1,000 a month in the market for 10 months, your hope when you do something like that is the market does go down and you get to invest some of that money at lower prices. Well, sequence of return risk is just the opposite of that, where people have to take money out because they're retired. And if they get unfortunate and the market goes down in their early years, it can negatively impact their retirement substantially. So I want you to be aware of it. How do you protect yourself from sequence of return risk? It's with your asset allocation. So what percent of your portfolio is in stocks and what percent's in bonds? Now, importantly, I don't want you thinking in percentages, which I just shared. That's what asset allocation is. But for you, I want you thinking, how many years worth of living expenses do you have in high quality, short duration bonds that are going to mature in 6 months, 12 months, 24 months, 36 months? How many years worth of those types of living expenses do you have in those types of bonds? And if you have 3 years or 5 years or 7 years, then if the stock market is down, you're not a forced seller in a down market. You have these bonds that in theory should hold up pretty well in price. And you can fund your living expenses from those bonds until the market recovers, and then you can rebalance things. By the way, as I record this, the market is yet at another all-time high. If your asset allocation is not right, rebalancing at all-time highs is not a bad way to go, right? Let's say you were 60% in the stock market and 40% in bonds. And because the stock market did really well over the last 16, 18 months, maybe the stock portion has grown and it's time to rebalance it. Better to rebalance when you're at all-time highs than after the market crashes and you say, oh, shoot, I didn't realize I was overweighted in stocks. Okay. Another important piece of advice as people are getting ready to retire is, maybe a year before you tell your company that you're going to retire, here's something to think about. It's going to sound crazy, I know at the beginning, but I want you to think about not saving any money in the last 18 months, the last 2 years before you retire. Candidly, your nest egg now hopefully is at the point where your nest egg is working harder for you than you can work for it. So your money is growing because of the money that you've saved versus the money that you're putting in. And one thing to think about is don't save that money. Don't save 10%. Don't save 15%. Don't save 20%. Instead, go on a nice vacation. Do other fun things and see how does it feel if instead of saving money, you spend it and you enjoy the journey more. Some people would say, you know what, that was really fun. And I have another 2, 3, 4 years in me before I want to retire. Now, I'm the guy on YouTube that tells people I want you to think about retiring sooner, but I want you to make the decision that's right for you. And I can tell you, I have clients that when they loosen the grips a little bit and you say, okay, essentially, you've built the nest egg that you need to build. It's strong enough that you can retire in 12 months. Let's ease off the gas a little bit and enjoy the money that we're making. And maybe you're going to want to work a couple more years and not retire. And that can have a significantly positive impact on your retirement account. Now, unfortunately, it can have a significantly negative impact on your life experience if you decide to keep working another 3 years and, unfortunately, if you have a health issue during that period of time. So the 4 most dangerous words for a soon-to-be retiree is just one more year. So we have to balance that, the just one more year syndrome with, maybe you're enjoying things and you don't have to retire. That pressure to retire, it's just too much. We're balancing too much. And so it's something worth considering. Okay, let's keep going. The next one that's super important is the concept that investments don't know that you own them. So if you buy a company and, all of a sudden it's not doing so well and the stock price goes down, the company doesn't know that you own it. So things aren't going to, oftentimes people try to buy things at the bottom and then they think they've called the bottom, but you know what? 9 times out of 10, you're not calling the bottom. It's really hard to do that. So if a stock is dropping in price and people think, oh, it's overdone, the market's overreacting, I think I should buy it. Well, you know what? That company doesn't know that you own it. It's not going to start to magically start turning things around. So the concept here is really cutting out the emotional aspects of investing. To the extent you can be stoic and use logic with your investments, it's going to benefit you. Our emotions are our biggest enemy in our investment success. It's called the investor behavior penalty. And there's a study done by a company called Dalbar. If you Google that, DALBAR, it's a think tank that analyzes investment returns. And what they find is, if they break out, here's the 10 investment classes that retail investors, average everyday investors, non-professional investors had a choice to invest through. They have access to our 401k investment history. They have relationships with different custodians that provide them that information. And what they regularly find is breaking out their investment opportunities into 10, 12 different categories. Most of those categories over a 20 to 30-year period do really well, but the average investor barely beats inflation. And that can have a significant impact. In fact, many Dalbar studies would say the average person after 30 years would have twice as much money in their retirement account if they had just not skipped around so much. Another important piece of advice is just helping people understand how expensive healthcare is in the United States. And it sounds crazy to have to say this, but even once we hit the 65 age and we're on Medicare, for the average person, according to Fidelity, they did a study on this, we are still looking at over $150,000 of medical expenses that aren't going to be covered by Medicare, that are above and beyond. $150,000 per person. So a married couple at 65 is looking at $300,000 worth of medical expenses. So earlier, I shared that people underestimate what their taxes are going to be and they don't include it in their budget. Another thing, unfortunately, that we underestimate is our healthcare expenses. So just be aware of that. If you look up Fidelity Healthcare Cost Study 65 plus, you'll find this report, but I believe it's $153,000 per person once you reach age 65, even though you have Medicare. And the final piece of advice that I think is really important is just this idea that when we're 60 years old, we have less than 1,000 weeks of healthy, active time in front of us. So I want us to be thoughtful. I want you to be deliberate. And I want you to spend each and every one of those 1,000 weeks. Hopefully you get a lot more, but on average, it's 1,000 weeks. I want you to spend each and every one of them wisely. And on that note, I also want you to think about watching this video here, which is 5 reasons to retire as soon as you can. Thanks for watching this video. I'll see you in there.